I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on Cyclesman.com. Welcome back to the show, Tim.
Jim, as always, thanks for having me.
The Japanese government has announced another round of quantitative easing, $32 billion worth, from a country that hasn't done well economically for the last 20, 25 years. They keep doing it. It doesn't help, yet they insist on doing it over and over. What's the deal with that?
Well, first of all, it's no surprise. I actually wrote recently in the last couple of updates that, to look for an attempt to save the market. Every time, I've seen it over and over and over again. Every time we get at a critical point, it's just like magic. You see some sort of a jawboning attempt, an announcement, or something like this, which I guess this is obviously an announcement of more quantitative easing. We've seen it time and time and time again. And it always seems to happen when the market's at a technically critical juncture. So I think that technical analysis is definitely something that is being watched, monitored, and is understood.
Why do they keep doing this, though? It's very expensive. It sucks money out of the government treasuries, and it doesn't seem to help the economy at all.
No, it certainly doesn't seem to help the economy at all. Like I said, you look at the underlying, the real underlying economic numbers. No, it's not helping at all. I don't know. It's insane. It's absolutely insane. And the only thing I can figure is it's as long as the market holds, it's kind of like a mirage. It's camouflage for the ugliness down below, because if the market, when it starts to give way, I think that's when all of the skeletons, as they say, come out of the closet. And it is, we're looking at an absolute mess. And I think as long as you can, as they say, kick the can down the road, keep the lid on this thing, the better off we all are. And so I think that's why the continued efforts are, we continue to see the efforts that we see.
Is this political? I mean, frankly, so many people are under the illusion that a stock market that's positive means a positive economy. Are politicians under that illusion as well?
I think so. I mean, I don't really know what somebody else is thinking, but yes, I mean, logic tells me that is probably the case. Like I said, it's like, it provides cover. I mean, it really does. I've called it a mirage. I've called it camouflage, but that's exactly what it is. As long as you can extend this thing, kind of make this market levitate here, then you have the illusion somewhat that things are good. But I'm telling you, I know we've been talking about this for a couple of years now, but it doesn't change. I mean, it is what it is. I don't care if they extend it another year, if it collapses tomorrow. I mean, it is a house of cards. They have backed themselves in the corner, so to speak, in that, they've created a financial holocaust. It just hasn't begun to come unwound yet. I see it in the charts. There's no question. And so I think that in and of itself is one reason they continue, because they see that, what other option do they have?
You've also talked about the volume of money and how that's a real indicator of what's happening.
Absolutely, and that has not changed. I look at that data periodically. It has not changed. The velocity of money, it continues to collapse. The job participation rate continues to collapse. And this whole thing of holding the market, like I said, is provided cover. And to clarify for maybe new listeners, what I think has happened, we have the business cycle. Everybody's heard about the business cycle. That's not taboo. I mean, you have business conditions ebb and flow. I mean, it's just nature. And we had the secular top in 2000, and things tried to roll. And the deflationary forces began to exert themselves. We saw it across the board. And in trying to manage the economy, with the decline into the 2002 4-year cycle low, we began to see, the Fed come out and do their thing. The central banks in general do their thing. And I think what the attempt was obviously to bridge the gap for the downturn of the business cycle, so to speak. Just bridge the gap, and then, we get to the other side of the cycle, things will pick up, everything will be fine, and we can just avoid the downturn. Well, it hasn't worked that way. It didn't work that way. The cycle has to be expressed. You have to have the purging. And so what they've done is they've blown the bubble up. They've made matters worse. Just like, I said all along into the 4-year cycle advance in 2007, everybody thought it was saved and that we had a 4-year cycle low and everything was great. And I said, no, they've only made matters worse. They've only made matters worse. And then we got the worst financial collapse into since the Great Depression. And this time we've seen even more of the same that created that bubble. The gap hasn't been bridged. We see no improvement in the underlying data, looking at, like I said, velocity of money, job participation rate, so on and so forth. I know of no one that is economically better off in general terms. You know what I'm saying? I mean, the average person is not. Healthcare costs has gone up. Yes, food, fuel prices are down some with crude oil being down, but in general, everything has gone up as the Fed has fought these deflationary forces. And what's improved? Nothing. The market's levitated. And so I don't care if we have, the fact that we are in the most extended 4-year cycle ever, and the fact that we have levitated here for 2 years does not change those factors. I mean, it still is what it is. And I don't know exactly at what point, it's going to tip and cave, but it will. And so all those underlying things are still in place. Nothing has changed. And every time we move to a technically critical juncture, we see some kind of an announcement, some kind of intervention, something, and it just continues to extend it. And that's kind of the thing that we're seeing here with this announcement from the Japanese central banks, I think you said it was.
Do you think these central bankers get together or call each other and say, well, this month I'll put in quantitative easing, and when that starts to dribble out, you're going to put in quantitative easing in Britain, right? Because they keep doing this kind of in a 3-month cycle.
Well, yeah. I mean, there is some logic. I mean, I see. It's obviously a coordinated effort. Absolutely. I mean, I've watched it enough to see that. There's no question. It's a coordinated. It's a global coordinated, because we're all in this together. And here's another side of this. People should be scared to death, and they're the most complacent that I've talked to. People who's been in this business a whole lot longer than me, and this is the most complacent environment that people can remember ever. And it should be quite the opposite, because they've kind of been lulled to sleep. But the sheer fact that they keep having to do this should scare hell out of people. I mean, if things were so good, it's kind of like I don't know, what would a good analogy be? It would be kind of like, I don't know, let's say you had a crime problem where you had to have more police, and so people feel more secure because you got more police. Well, I see that the opposite. I mean, if you happen to have more police because of more crime, the issue is you got more crime. That's the root issue. And the root issue I'm trying to say with this is that if things were so good, then why would they be doing what they're doing?
Tim, I look at it as you have a dam with rising water on one side, and they throw a few more sandbags on top of the dam. But sandbags after a while are going to fall over, and that volume of water on the other side really is going to slam you hard.
It is, and the thing that I almost feel like I'm apologizing for, and it's not. I mean, I see what I see, and I'm going to tell people what I see until I don't see it anymore. And it's not an apology. It's although it almost sounds that way, and I mean, maybe it is an apology. And that is, I hate to get on here every show and talk about how it's a bubble and it's, the Dow theory stuff is still in place and how it's, like we're at critical mass here, and then it just extends. But that's a separate point we can't help. I cannot help that. Nothing has changed. Nothing beneath the surface has changed. If we would get a washout into a 4-year cycle low, and the volume characteristics of the market start to change, and then we get, we see the velocity of money pick up, we see some real economic growth, then okay, we got something there. But the fact that this has been extended and none of that stuff has changed and we haven't had a washout, the facts are what the facts are. And so, on the one hand, I feel like I get on here and try to defend the position, and that's not the point at all. The point is the data is what the data is. And so until we see something change, it is what it is. And we have not seen a washout of any substance. I mean, this is, if you go back literally, I mean, it's a matter of history to 1896. Think about this. 1896, the inception of the Dow Jones Industrial Averages, the Dow Jones Industrial Average. The 4-year cycle has averaged 48 months. That's why I call it the 4-year cycle. And then, within the concept of that 4-year cycle, I developed these DNA markers because let's say you get a high. Well, how do you know it's the 4-year cycle high? How do you know it's just not a high along the way and the market's going to turn back up and go higher into the 4-year cycle top? And then the same thing with the 4-year cycle low. You get a little downturn. How do you know that it's not just a minor downturn along the way and that you've got the 4-year cycle low? So you have to have some parameters to guide you within that concept of that cycle. That's why I developed these DNA markers. And so since 1896, I can go through and identify these 4-year cycle tops and bottoms, and I can say, check, 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 check. All this happened. Check, 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 check. All this happened at these tops and these bottoms. And coming out of the 2007 low, I know without a shadow of a doubt, no question, that was the 4-year cycle low. And I cannot look at a top between the 2007 low and the 2015 high that qualifies for a 4-year cycle top. They're not there. The parameters are not there. So what I'm saying, and I cannot at this time look at a chart and see any indication of a 4-year cycle low. So by default, we have the most extended advance in history. In history. And we continue to see an effort to extend it further. And like I said 1,000 times, there is no time in history, not only let me back up, in addition to the most extended cycle in history, there's no time in history that manipulation has ever lasted. It always ends badly. And so we're seeing the most manipulation ever in conjunction with the most extended cycle ever. I don't know how much longer the insanity can continue. Maybe maybe we've seen the top. Maybe it's 6 months down the road. All I know is we go through these technical junctures, these technical windows, which I talk about in the letter and in my updates. And every time we go through one, you're in the minefield. That's an opportunity. And then the opportunity, it's either going to pass or it's going to take root. And, we've been walking through that minefield for a couple of years now.
We'll have more with Tim Cycles Van Wood right after the break.
GEM International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Welcome back. We're speaking with Tim Cyclesman Wood. Tim, with all these manipulated markets, what's happening with gold right now?
I'm glad you mentioned gold because it wasn't even on my mind. Do you remember? You remember? This is a perfect example of statistics, and I want to use gold and I want to use crude oil to make a point. Back in July, I said that I thought we had the intermediate term cycle top. And throughout August, the market, now this is a micro version of what we're seeing with equities. And then all throughout August, the market gold just kind of levitated. It didn't go back above the July high, but it really didn't go anywhere either. But at the same time, the structure told me that we had seen the top. The data told me we've seen the top. And then we get into September and it's more of the same. It just kind of levitated. It hadn't gone anywhere. But nothing changed to tell me that we had not seen the top. I mean, the evidence was there. And I kept saying, we're going lower, we're going lower, we're going lower. Well, finally gold broke. And that's what the statistics said. I mean, the statistics tipped the scales heavily toward lower prices. And it finally broke. And now I think we're at or near a short-term low, and there's a rally in the cards. But then I think we continue to go even lower because the statistics suggest that we should revisit that December low from last year. And until the evidence changes to tell me that nope, something's a little different here, we've got the low, then I have to stand by that statistic. And it's working out here. We're seeing it in real time. I think you probably remember another example of statistics and market behavior is back in, when was it, 2014, talking about crude oil. Well before crude oil moved down to the $20 range, I said that, the retest of the high in 2014 was a counter trend rally. It's all in print in the letters. We're going lower. We started down, and then I gave projections, said we're going into the 20s. And when those were done, I think we were still right around $100. It sounded crazy, but it happened. And I didn't just dream something up and say, you know what, I'm going to make this really outlandish call, and God, I hope I'm right. And if I am, then, I got a 50-50 chance of being right. I'm just going to make this really ridiculous call. No, I did it based on statistics and math and cyclical structure and probability and so forth. And it happened. And the same exact thing, I say all that to say this, the same exact thing about equities, about this market. I don't care that it's extended. I can't help that. But the same methods apply. I know where we're at. I know it's the most extended cycle, and I know how it's going to end. The stuff in the middle with the obvious manipulation is what's muddying, the waters and makes it a hell of a lot more difficult, for people to understand and really, I guess, believe at this point because of the complacency and how things have been just, so extended. But anyway, the point is that these statistics, the stuff works. And, our expectation with gold's right on track. And, I stand by the same methods with equities. It's a hell of a mess waiting to happen.
Tim, thank you so much for chatting with us.
Thank you.
My guest has been Tim Cyclesman Wood. You can check out his newsletter, Cycles News and Views, on cyclesman.com. You're listening to HowStreet.com radio. You can find us on Twitter at TalkDigitalNet. You can ask us some questions by emailing us at info@howstreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.